Hello, everyone, and we couldn't avoid talking about Costco. Okay, just reported earnings. In the after hours here, we're a little bit late to the party, but that's okay. That's plenty okay. So Costco, you see after hours up 1%. Now you look at the history of the stock, and it seems to me that they needed to do a lot given this market condition based off of where the stock's really at. I mean, this is a stock that over the last year has traded up 40+%, the last 5 years up 200%, and really did not see much of a dip. When you look at 2020, they really didn't have a dip at all. This is one of the best performing stocks last year. And when you've seen that lately in the market, you're expecting that really these companies have to hit all three points in their earnings to actually see an increase in share price as a result of it. So typically you'll need a top line revenue, bottom line, net income. We want to see the net income line. We want to beat on that aspect. And people want to see a beat in terms of guidance. So curious what that looks like. Again, Costco's kind of held off from giving guidance lately just because of uncertainty in the market, which is understandable given still relatively uncertain spending patterns, but they're very high, by the way. People are buying the heck out of stuff, and places like Costco are really capitalizing on it, where people are still buying in bulk, where they started maybe memberships last year where they weren't before, and they're really doing a good job retaining those members. So let's get into these numbers here, and let's just be clear. Looks very nice so far off the initial report here. Non-GAAP EPS line of 277 and a GAAP EPS of 298. Beats by 33 cents. Very nice to see. Love it. Love everything about it. What else you want me to say? I love everything about it. I love it. From a revenue standpoint, $50.36 billion is an increase of 16.5%. That's right. This is a retailer growing by 10+% when they're already making tens of billions of dollars. It's hard to see it. It's hard to see a retailer do that. They just don't do it. So to see that number's fantastic, and it's a beat by 610 million. So really nice beat. What more can you say? It's just nice. It's just nice stuff. As far as comp sales, 9.9% comp sales. In the U.S., 8.3% in Canada, and 10.9% international. Total company 9.8%, and e-commerce grew 13.3%. And this isn't necessarily the company you look at in terms of e-commerce, right? It's a big wholesaler with a lot of bulk products, and you don't necessarily look for those online. It's just unfortunately not necessarily the business for it quite yet. And I think at some point they will get there as e-commerce takes off in general. But not a lot of people are quite into the bulk e-commerce purchases quite yet, but trust me, they will get there over time. Looking at the finer details here, we see obviously a 16.7% increase in net sales. If you look at areas for that, U.S. grew 14.9%, Canada up 17.2%, other international up 13.4%. Total company 15%, and obviously a 14.3% e-commerce here when you're talking about the non-adjusted numbers. These were the adjusted numbers. We like looking at the normal numbers, okay? We don't want adjusted. We want to see the goods, okay? So that's really good to see. That's just really good to see. I love it. Net income came in at $1.3 billion compared to $1.1 billion of the year prior. And this is a company that's continually been able to show really good growth in the net income line. And I pulled this up for a good reason. This is one of the better net income charts you can see anywhere. I mean, you very, very rarely see any red. We saw a dip in 2020, understandably the very first quarter of the pandemic, so understandably there were a lot of costs that came with net income, decreasing there, a lot of costs that came with health and safety, stuff like that. So I get it. But other than that, look at this chart, and overall, if you look trailing 12 months, it's been pretty well in a very steady increase, even really since 2006 here. But obviously started taking off. You can see around the 2012 range, they've really taken off. And And because that they've been able to do some pretty good things with that extra cash, which we'll get into in just a little bit. So 828 warehouses total, 572 in U.S. and Puerto Rico, 105 in Canada, 40 in Mexico, 30 in Japan, 29 in the UK, 16 in Korea, 14 in Taiwan, 13 in Australia, 4 in Spain, 2 in each France and China, which again they'll work on expanding here. There, it'd be massive, and 1 in Iceland. I don't know how much business the one in Iceland does, but I'm sure it's pretty packed if it's, one of the few stores that people have there, that sells very quality products. So again, there's a lot of room for growth here. When you're talking about e-commerce, they don't even do e-commerce in China quite yet. China's a very big growth factor for them in the future, and I think they're going to be able to do a lot of good things there for sure. And they'll continue to really grow that store count as you see things progress. So net sales, obviously beautiful stuff. As you see where that 50 billion came from, it includes membership fees, which is obviously a very, very key aspect here, because when you take into account membership fees, that is a 100% profit business. Obviously, they're not paying anyone for those membership fees, right? It's just someone's paying either 55 or 110. I think it's 110 now for the executive. They're paying to shop there, and that money is entirely going right back on the bottom line as 100% profit, because it's not a good that they have to pay for to sell it. This is entirely a service that they're offering that really is a service that requires no maintenance to it, right? Just your normal hourly workers that are working there. So membership fee is fantastic, because you see that increase, you'll see profit increase as well. So the more members they have, just the better. Merchandise costs saw an increase, which is understandable, because you talk about them selling a lot more as well. Operating income, great numbers there. Great increase. I mean, I like to see it a lot. I like to see it. And obviously you saw the net income line. It's a good increase. It really is. Yeah. Love to look at the balance sheet, because it's got a lot to do with this company. When you talk about, is this company worth taking a look at? Well, let's look at it. 33.8 when you're looking at total current assets. And they're only comparing it to a month ago, which isn't quite fair. I'd really like to look either 9 months or year over year, but I understand why they do this, because this is technically Q1 for them, which is a weird fiscal year that they have, but that's okay. So they've increased the cash position a little bit here, as well as the inventories, which is really preparation for the quarter over December, which is the main gifting quarter. So that's a good reason why they've got so much in terms of inventories, and they were obviously less. They had a little bit less in the middle of the year for sure. So total assets in general, 64.1 compared to 59.2. So most of that's due to an increase here in the total current assets, as you saw. From a liability standpoint, they do have quite a bit of current liabilities, 33.3 compared to 29.4. Increased by really just about as much as they increased the total current assets, and it's sitting right around that amount, so not beautiful. But the company doesn't have a lot of long-term debt for sure. $45.1 billion in total liabilities compared to 41.1. Again, grew similar numbers here. Shareholder equity actually did increase by $1 billion, though, $19 billion compared to $18.07 billion. So overall, it's a nice balance sheet. I mean, from a retailer standpoint, I like the balance sheet. And they're gaining a lot of cash on hand. And you know what happens when they gain a lot of cash on hand? Look, you got to take account for this stock is when you're talking about buying it, well, it's trading at a high valuation, over 45 PE ratio, which is really expensive when you consider other retailers out there. And a market cap of $23 billion or $231 billion is actually quite cheap. That's what they're going to do in revenue this year, is $230 billion. So the market cap is quite cheap, but it is trading at a very high PE ratio. So by metrics, this company is not necessarily overvalued in my perspective. When you look at a market cap standpoint, I don't think this company's overvalued. On a PE basis, I believe it is, but overall, I don't think it is, because you got to consider in the market cap there, and the price to sales is just, it's not that expensive. It's kind of in line with other retailers, right around 1. And I think this is a stock that deserves a little bit higher, of a multiple than really other traditional retailers, because they're able to add a subscription service built into their business model. And you got to account for the dividend. It's a small dividend, but as I mentioned, with this massive net income growth, what you've been seeing from this company really since 2012, they've occasionally paid out special dividends here, $7 just per share back in 2012. Then in 2015, $5, just giving it out. Then you saw in 2017 here, as highlighted, $7 again. And then just earlier, really at the end of last year, November of 2020, $10 a share handed out to the shareholders. So again, this company's looking to really reward shareholders. They want people to invest in the stock. I like it a lot. I think Costco is one of the best long-term holds you can have there. It's a really good rock to the portfolio, and I think it can provide a lot of decent gain for you, actually. So that's what I got for you, and I hope you have a great day.